Okay, so it's very important to understand the concept of a statistical edge. A statistical edge is one based on lots and lots of hours of research. So let's assume that whatever the edge is, it has a 60% effectiveness rate or a win rate. And that means that essentially you're going to get 60 winners for every 100. Now, the sticking part with a statistical edge in the markets is that you don't know which 60 out of 100 are going to be the winners and which, therefore 40 are going to be the losers, right? So simple math, right? You take 100 trades, you have 60% win rate. You're going to expect to take somewhere around 60% of your trades home as winners and then 40% home as losers. You don't know before you take the trade which is which. That's a classic statistical edge, and really what 99.9% of all market participants engage in. They've got some statistical edge in the marketplace, and they're willing to lose a certain percentage out of every 100 trades in order to have a positive expectancy over time. Now, what we've done is take another layer of statistical analysis on top of a traditional statistical edge. So if we took that same trading strategy, that same idea, that same concept, and then overlaid predictive failure analysis, which will allow us to identify and avoid 80 to 90% of potential losses before you take them and get stuck, let's look at the math there. Same 100 trades offered by the market. You're still going to see the same number of winners. You can't manufacture more winners. Predictive failure analysis is a layer of analysis which sits on top of your statistical edge. So you still have the same 60 winners, but look at what happens to your losers. If you're able to identify and avoid 80% of your losers, now you're only left with 8 losers. If you're able to identify and avoid 90% of your losers out of that 100 trade sample, now you're only left with 4 losers, which gives you an effective win rate. In other words, the win rate that you actually experience of 88 to 94%. But look at another thing that's happened here. There were 100 potential trades, but if you took the 60, obviously, that won, and the 4 or 8 that ended up losing, because again, there's nothing that's 100%. Now you only took 68 trades out of 100. You're working less and you're making more. It's a win-win scenario.